Welcome back to the NITE Economics YouTube channel, and today we're going to be studying where are we currently at in the cycle yet again, and are we close to some kind of a recession or at least some kind of major pullback in the S&P 500, and what does that mean for us, essentially for us investors. So let's start by looking at the S&P 500. As you could see, it's had a bit of a pullback from it pretty much stalling out and doing nothing for several months, pretty much since October. Now it's pulled back. Let's see how much it's pulled back from all-time highs. Approximately, not too much. It's about 5% pullback, so nothing too crazy. But I do expect this to continue for a little bit before possibly popping up higher and then coming down, but we will see. Only time will tell. But as of right now, this still doesn't look too bad. It's only below the first major moving average here, the exponential, the 5 exponential on the monthly. So it's not looking too bad yet. So let's see how this plays out in the next couple of months. Oil. Now we're going to take a quick look at oil, and then this will kind of help gather my ideas or my thoughts of what I'm looking at and what I'm expecting to potentially happen. So if we take a look at oil here, the price of oil, if we exclude this short 2020 black swan recession, if you will, the price of oil, and this is energy as a whole, usually spikes during a recession, and it could be sometimes in the middle of the recession or just before the recession. And this is true pretty much for every single recession. So as you could see here in the one in 2008, the great financial crisis, oil spiked and then it had a big drop off near the end of the recession, once it was coming to an end. If you could see here in the one in 2000, so the cyber, what was it called? The dot-com bubble, oil spiked just before the recession, so a couple of months before the recession officially was called, whatever, announced, if you will. And then it started coming down into the recession, and then it continued after a recession was over. As you can see here in the late 80s, early 90s, we had another recession here. And then this one, you could see that it spiked right into it, and then it came down. And that's pretty much as far as this chart goes. Let me remove all these moving averages because it might make it a bit confusing. So let's move all of these moving averages. And yeah, actually here too, in whatever recession this was, even though you can't see it all that well here in this chart, but you could see it spiked into it, then it came down, and then here, so it's just kind of coming down as a whole. So at least from the 90s onwards, you could see that this has happened pretty much every single time outside of the 2020 Corona dump black swan, where actually the complete opposite, right? And what do we have here? We have, due to the ongoing war, we have a significant spike in the price of oil. Now, is this pretty much a warning that we're currently entering a recession? Or is it something else? I think this is probably likely, because as we could see, there's other things that are in place to tell us that we are in a recession. One of them is the S&P 500 stalling out. So this is a crucial component. I'm not saying it's 100% right now, right? But this is a crucial component. This typically happens. I've shown it in some of my other YouTube channels, like here, that'll tend to stall out right before the recession. Same thing here. Same thing here. I'm not saying it's not gonna continue. I think it will continue. There'll be a recession pullback, and then it'll continue to all-time highs like always, because the money printers will be turned on at that point. So, but we're seeing the second component that is crucial to give us an idea if we're nearing a recession, and that's a spike in energy, in this case crude oil. And then let's take a look here at so we're looking at the 2-year yield, and the 2-year yield is said to be the closest representation of where the neutral interest rate currently is. So the neutral interest rate is the interest rate that is neither accommodating nor stimulating the economy, which means that if we are sitting at that neutral rate, the economy is not growing or contracting. It's pretty much staying the same. It's going to stay flat. As you could see here, this green line is the Fed funds rate. So this is the Federal Reserve's overnight lending rate, which is currently sitting at 3.64, and it's pretty much right in line here with the 2-year yield, which again is a representation of what many people think is the neutral interest rate. And the neutral interest rate isn't something that you could see right now. It is something that you can measure in the past, but right now you can't really measure where it's at. And the 2-year bond yield is what many experts think is the closest representation of where the neutral interest rate currently is. But nobody really knows. So as you can see, it's pretty much in line with the Fed funds rate. So the neutral interest rate and the Fed funds rate is currently pretty much at the same place. In order for the economy to be not restrictive, the neutral interest rate needs to be above the Fed funds rate. Right now they're at the same place. It needs to be above. So that means if the neutral interest rate gets above the Fed funds rate, it means the economy is going to be less restrictive. Then hence you will have more economic activity. The economy is going to start to grow, etc. If the opposite is true, if the neutral interest rate is below the Fed funds rate, it means that the economy is restrictive. So the economy is not growing, and usually you're going to go into a recession. Now, this is the interesting thing, because I follow the uneducated economist. His channel is fantastic, and I think he is bang on when it comes to describing what is going on in terms of the Federal Reserve's monetary policy. The Federal Reserve's monetary policy is no longer based on interest rate adjustments. This no longer does anything for the economy. But what their true ammunition is, and what their true, what actually stimulates the economy now is speaking about what they're going to do, right? So their inflation expectations, 1, and 2, what they are going to do in order to stimulate the economy. So their words are what actually matters in terms of kind of getting the market to go in the direction that they want. So right now, this war, I don't think is a good thing overall. I don't like war at all. But for the Federal Reserve, it's a wonderful thing, because what happens during war? You see spikes in oil. You're going to see spikes in other assets that are crucial for a long-term ongoing war. When you see things that are happening in this war where you have a significant artery where 20% of the world's oil, and not just oil, natural gas reserves, if you will, pass through this strait and is now being locked off. Well, what is that going to do for the ability to transport other crucial things that are needed for, like, the farming industry, fertilizers? Europe is going to need a lot of these things as well, because now they're going to have to be more reliant on Russia, and we all know what's going on over there. So what is this going to do for the overall economy, right? This is going to essentially raise inflation expectations. So the economy is going to expect higher prices into the future, not lower prices. And when this happens, it's going to raise the neutral interest rate. And it's very interesting, because now we have seen in the last month that the neutral interest rate has raised up due, and let's take a look at the weekly. Yeah, and it's due pretty much because of this situation over there. So if the neutral interest rate truly is, so if the 2-year bond truly is an accurate representation of the neutral interest rate, then the Federal Reserve, for them, this is fantastic, because inflation expectations go up, and that means that the neutral interest rate is going to get above the Fed funds rate, and they don't need to do anything. They literally do not need to lower interest rates. So we will see what happens here, right? If this keeps going up, significantly. Like, I mean, if it gets pretty much where it was, when was the last high? It was in 2023. If it gets up to where it was in 2023, right, it's about, what is that, 5%? Around 5% mark. It's going to be well above the neutral interest rate, right? So we will see. Or sorry, the Fed funds rate will get well above this opposite. The neutral interest rate, aka the 2-year bond yield, will get above the Fed funds rate, thus making the economy less restrictive. And they don't even need to lower interest rates, because again, lowering interest rates is not the true ammunition that the Federal Reserve has. It is their words on what they are going to do with the economy. And them raising the neutral interest rate, they want inflation, right? They say that they only want around 2% on average. They need more inflation in order for the economy to be less restrictive, and that way they could create more growth into the long term. The only thing that I think the Federal Reserve won't be able to do is if truly there is a recession, and the last component that would tell us if there is a recession is if the unemployment rate starts to skyrocket significantly. In one of my last videos, I posted about the unemployment rate and how it's been trending higher for like about the last 2 or 3 years. And that's the first time it's trended slowly higher without triggering a recession. But if you have all of a sudden a non-linear move up to the upside, which can be caused by the S&P 500 dropping significantly, then I think the Federal Reserve will be in a bit of a pickle, because I don't think they can really do much about that. Because they're going to be forced to possibly lower the interest rates a little bit, at the same time try to manage, because they have two things that they need to take over. They have a double mandate, is what it's called. They need to make sure that there's stable prices in the economy, essentially, and they also need to make sure that there's full employment, right? So they would have to start turning on the money printer. But I think if they could manage to not turn on the money print, if they can manage if they can manage for the unemployment rate to not go up higher in a non-linear way, so a sudden spike up in unemployment rate, if they can manage this, and something happens where like the S&P 500 drops enough, where there's enough of a scare where they turn on the money printer without having to actually take care of that end of their double mandate, the unemployment part, I think they'll be in a very, very good position to start spending money into the economy. Thus, that will create more inflation expectations, plus this war that will push the interest rates higher, the neutral interest rate, of course, without them having to really touch the Fed funds rate. Right, because this is not, I think this is something that they want to save into the future when they really, 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 really do need it. Where they, for example, if you have both things happening, right, you have the neutral interest rate going up, and then they could drop interest rates closer to, maybe 2.5 or something, maybe even closer to 0, then I think it will have some kind of effect. But as of right now, it's just too close. Even if they were to lower it by like 50 basis points, it's still too close to the neutral interest rate. So for them, again, having inflation expectations to be higher into the future, people thinking it's going to be higher, people are going to be reacting, and their behavior will be that of as if there's going to be higher prices into the future, is exactly what they need, and exactly what will essentially get them out of this specific mess. And I think that's it for today. This video is a little bit complicated. I should make more videos explaining the neutral interest rate. I've tried to do it. It's just it's not an easy topic to explain, because I think the uneducated economist does like a fantastic job of explaining this. He explains it like no other. So I really do suggest you check out his videos, because then this will start to make a lot more sense. And some of the things that are going on right now in the news start to make a lot more sense, because the news wants to spread fear, uncertainty, and doubt, because they want you to react a certain way. They want you to behave a certain way. And if they want you to think things are going to go up into the future, which they will, it's not like they're lying, right? There's a war that essentially cuts off 20% of the world's, oil and energy supply, then of course, naturally, prices are going to be more expensive into the future, so inflation expectations will go up. So yeah, so I hope you're liking the content. If you do, drop a like, subscribe to the channel. It's very useful. And yeah, leave me any comments if you want me to talk more about this and something similar, or you want me to explain the neutral interest rate a little bit better, and or anything related to pretty much what the Federal Reserve does with their monetary policy. I'll be more happy to do so. In the meantime, check out the Uneducated Economist. He's fantastic. And I'll see you guys next time. Take care. Bye.